In a lot of ways, investing is like tennis. In tennis, having a killer serve and a great backhand will win you a lot of points, but any advantage that these skills confer can be quickly wiped out with a string of double faults or unforced errors. At the end of a 5-set match, it's often the player with the least mistakes who wins. Just being able to consistently get the ball back over the net, no matter what your opponent throws at you, counts for a great deal. Investing is pretty similar. Unless you know how to avoid the most common mistakes of investing, your portfolio's returns won't be anything to get excited about. You'll find that it takes many great stock picks to make up for just a few big errors. So, I want to introduce you to 7 easily avoidable mistakes that many investors frequently make. Resisting these temptations is the first step to reaching your financial goals. 1. Swinging for the fences. This ties back to the importance of buying great companies with strong economic moats. Loading up your portfolio with risky, all-or-nothing stocks, in other words, swinging for the fences on every pitch, is a sure route to investment disaster. For one thing, the insidious math of investing means that making up large losses is a very difficult proposition. A stock that drops 50% needs to double just to break even. For another, finding the next Microsoft when it's still a tiny startup is really, really difficult. You're much more likely to wind up with a company that fizzles than a truly world-changing company, because it's extremely difficult to discern which is which when the firm is just starting out. In fact, small growth stocks are the worst returning equity category over the long haul. Why? First, the numbers. According to Professor Kenneth French at Dartmouth, small growth stocks have posted an average annual return of 9.3% since 1927, which is a good deal lower than the 10.7% return of the S&P 500 over the same time period. Lest you sneeze at that 1.4% difference between the two returns, let me point out that it has an absolutely enormous effect on long-run asset returns. Over 30 years, a 9.3% return on $1,000 would yield about $14,000, but a 10.7% return would yield more than $21,000. Moreover, many smaller firms never do anything but muddle along as small firms, assuming they don't go belly up, which many do. For example, between 1997 and 2002, 8% of the firms on the Nasdaq were delisted each year. That's about 2,200 firms whose shareholders likely suffered huge losses before the stocks were kicked off the Nasdaq. 2. Believing that it's different this time. The 4 most expensive words on Wall Street are "it's different this time." History does repeat itself, bubbles do burst, and not knowing market history is a major handicap. In the spring of 2000, for example, the financial press started writing that semiconductor stocks were no longer cyclical. That turned out to be pretty close to the top in chip shares. A year later, energy stocks were all the rage, and many analysts were projecting their earnings to grow at 20% for the next several years. Then, the economy slowed, hurting the demand for power, and new plants came online, driving up the supply. As a result, energy stocks such as Mirant and Calpine tanked 50% to 60% even before the Enron debacle sealed their fate. The point here is very simple: you have to be a student of the market's history to understand its future. Anytime you hear someone say, "It really is different this time," turn off the TV and go for a walk. 3. Falling in love with products. This is one of the easiest investment traps to fall into. Who wouldn't have thought that Palm was a great investment after buying a Palm Pilot when they were first introduced a few years ago? It seems entirely logical, but the reality is that great products do not necessarily translate into great profits. For example, Palm was the first company to invent a handheld organizer that was relatively easy to use and affordable, but consumer electronics is simply not an attractive business. Margins are thin, competition is intense, and it's very tough to make a consistent profit. Although great products and innovative technologies do matter when you're assessing companies, neither matters nearly as much as economics. Sure, Palm made a great device that millions of people purchased, and the firm even acquired one of its chief competitors, but the industry's dismal economics still caught up with the firm in the end. Palm lost hundreds of millions of dollars in 2001 and 2002, and as of mid-2003, the firm's shares had plunged more than 98% since they started trading in early 2000. When you look at a stock, ask yourself, is this an attractive business? Would I buy the whole company if I could? If the answer is no, give the stock a pass, no matter how much you might like the firm's products.